Bitcoin dipped briefly under $118,500 this week after the release of hotter-than-expected PPI data, reigniting inflation fears and sparking a short-term pullback across crypto markets. This marked the first bearish engulfing pattern since mid-July, leaving traders cautious about the historically weak September period. Despite this, on-chain metrics show strong dip-buying activity, which has prevented a more severe correction, for now. In today's video, we'll break down whether this PPI print truly changes the macro picture for crypto, or if it's simply a shakeout before higher levels. We'll also explore why this September could defy historical norms and potentially set up a strong final quarter for 2025. If you enjoy this, hit the like button, and if you're new, subscribe so you never miss updates. Let's dive in. The U.S. Producer Price Index for August came in hotter than expected at 3.7%, against a forecast of 2.9%. This immediately triggered concerns about renewed inflationary pressure, largely tied to rising supply-side costs and tariffs. The reaction was swift. The U.S. dollar strengthened, Treasury yields ticked higher, and risk assets, including Bitcoin and major altcoins, experienced a pullback. Leading into the release, Bitcoin and Ethereum were trading near their all-time highs, supported by strong momentum and growing institutional participation. The hotter PPI print disrupted sentiment, pushing Bitcoin under $118,500 as traders reassessed risk exposure. Yet, despite this dip, the broader trend remains intact. Technical indicators suggest this is a pause rather than a reversal. Institutional demand for both BTC and ETH continues to accelerate, providing a strong base for the market. For many traders, this dip could be a buying opportunity rather than a sign of weakness. Looking at the charts, Coinbase's premium index hit its highest level in a month, reflecting continued U.S. spot demand. Bitcoin dominance remains below 60%, signaling that capital is rotating into altcoins. BTC remains comfortably above key support levels, strengthening the altcoin narrative. Stablecoin flows have been a particularly bullish signal. Since the recent dip, USDC inflows to exchanges reached $388 billion, suggesting traders are positioning fresh capital for deployment. Short-term holders' capitulation is muted. Only 16,800 BTC were moved at a loss, far lower than prior sell-offs where 48,000 BTC were liquidated. This highlights confidence among traders. Earlier in the week, CPI data had created optimism for a larger September Fed rate cut. However, the stronger PPI print has cooled expectations. Market pricing now reflects a roughly 92% chance of a 25 basis point cut, with only 8% chance of no cut at all. Even with these adjustments, short-term uncertainty has not translated into bearish conditions for crypto. On the contrary, the market is showing resilience. Stablecoin inflows, continued demand for ETH, and BTC holding key levels all point to steady accumulation rather than panic selling. Now let's flip the narrative. Historically, September has been weak for crypto, but this cycle could be different. Markets often defy widely held expectations. When the majority is positioned for a sell-off, surprises are common. ETH continues to show remarkable strength. Corporate treasuries are aggressively accumulating, with firms like Bitmine adding over 1.17 million ETH. BlackRock's ETH ETF recorded $640 million inflows in a single day, pushing total ETH ETF inflows above $1 billion for the first time. This is real institutional capital positioning for long-term growth. Bitcoin dominance continues to trend lower, under 60%, confirming the ongoing rotation into altcoins. Even during the recent PPI-driven pullback, BTC dominance failed to regain key levels, underscoring the strength of altcoin momentum. Stablecoin dominance sits at the 6%, leaving significant dry powder on the sidelines. This capital could rotate into altcoins, creating liquidity that fuels rallies. With $7.2 trillion parked in money market funds, even a small reallocation into crypto could provide a substantial tailwind. Supply-side dynamics are supportive as well. ETH staking locks a significant portion of tokens, and corporate accumulation is steadily absorbing available supply. Exchange balances for major altcoins are at multi-year lows. This creates a supply squeeze that historically precedes explosive moves in both BTC and altcoins. The 2025 market cycle is also different from prior years. Institutional-grade infrastructure now exists, including ETFs and custody solutions, providing sustainable capital inflows rather than speculative retail-driven bubbles. Year-to-date, Bitcoin and ETH ETFs have seen nearly $30 billion in inflows, with more allocations planned by institutions. The macro backdrop also favors risk assets. Markets are pricing in a potential September Fed cut, which historically supports equities and other risk-on assets. Lower borrowing costs can drive allocations into crypto. Regulatory clarity around staking, DeFi, and corporate treasury operations further strengthens the structural demand picture. Rotation into altcoins continues to gather steam. ETH BTC is holding key levels, Bitcoin dominance remains capped, and stablecoin reserves are waiting to be deployed. Historically, when capital rotates from BTC into altcoins, it leads to broad-based altcoin rallies. If September avoids its usual sell-off, this rotation could act as a launchpad for a major final quarter push. Markets often surprise when consensus bets are extreme. While many expect a September dump, positioning is already skewed bearish. This sets the stage for the market to potentially defy expectations. Historical patterns are just statistical probabilities, not guarantees. Current supply-demand dynamics, institutional positioning, and macro tailwinds could produce a very different outcome this year. PPI data caused a short-term pullback, but it hasn't derailed the overall bullish structure. Stablecoin inflows remain high, BTC dominance is capped, and ETH BTC is holding support. Institutional accumulation, supply constraints, and regulatory clarity all support a strong market structure. Macro tailwinds, including a likely Fed cut and available capital in money markets, could boost crypto demand. September could surprise by being a month of accumulation rather than a traditional dump, potentially setting the stage for a strong Q4 2025. So, what do you think? Will September bring the usual sell-off, or could we skip the dump entirely and march straight into a bullish final quarter? Share your thoughts in the comments. I always love reading your takes. Thanks for watching, and I'll see you in the next update.